Okay, Chapter 5 and adjusting entries. So in this section, we're going to show you a little bit about what are adjusting entries and how we use the worksheet to record those, and also how we then get to the financial statements. And one of the things I just want to comment about a worksheet is that it is a tool. Not all businesses and companies actually use a worksheet, but for the purposes of trying to show you how the adjustments affect certain account balances, this textbook and many textbooks like to use the concept of a worksheet just to kind of demonstrate the visual aspect of how that works. And you can see on this particular worksheet how you have a trial balance, and then you have a column, which is where you're going to make certain adjustments. And then notice how you also have a debit and a credit column under each of these, which basically correlates to the journal entries of debits and credits. And then you'll notice that you have the trial balance, then your adjustments, and then you have what's called the adjusted trial balance. And then it's at that point, I'm going to stop right there. It's at that point, then you can then do your number one, your income statement, and then you can then eventually get to your balance sheet. So this slide just shows you the basic idea of doing a trial balance by telling you that you need to enter the certain account names and then put them in the appropriate debit or credit columns. You got to total the debit and credit columns because you always got to make sure that they're equal. And it says place a double rule under each of the trial balance. That's just petty bookkeeping stuff. The idea is that you want your debits to equal your credits. Notice here's a sample worksheet that's got the account names already listed for you right over there. And then eventually what will happen is you'll enter the amounts in the appropriate column to get your trial balance. And at that point, you'll start to do your adjusting entries, which you're going to either add or subtract to these accounts that are already into your trial balance to then get to your adjusted trial balance. And as you can see, this is, going from your ledger, going ahead and entering a balance in for cash. And of course, you do that for any ledger account balance. You're just going to basically transfer it to the trial balance to make sure that your debits equal your credits. And notice once you have entered all the balances from your ledger, you total all your debits, you total all your credits, and if you look at the very bottom, you got 150,500 total debits equals 150,500 total credits. And then next up, you would use this column then to enter whatever specific adjustments you're going to enter. And then once you do that, then you'll either add or subtract to these amounts in the trial balance to then get the adjusted trial balance. So this first example is with supplies. So it tells you that you started the month with $1,500 in supplies, and at the end of the month you had $1,000 of supplies remaining, which means that you must have used $500 worth of supplies. So notice you start with $1,500. That's what is basically going to show up in your ledger. But the idea is this is the ending inventory. I'm sorry, the 1,000 is the ending inventory at the end of the period. So you have to somehow show somewhere in your financial statements that you've actually used $500 worth of supplies. So this is going to be where your first adjustment is going to come into play. You're going to have to make an adjustment for the supplies account. And notice here there's a debit to the supplies expense in the adjustment column here, and you're going to credit the supplies account there. And notice here's your debits equal your credits. Now, just so you know, you'd also write these in a journal, before you'd actually do any of this. So let me just write this off to the side if this helps you. If you're going to actually write out the journal entry, you would have supplies expense with a debit of 500, and then you would credit supplies for 500, and you actually would do this in your journal, just like you would record any basic journal transaction, and then of course you'd have to post that to your ledger. But they're just trying to show you in this case how the worksheet can just try to give you the visual on how each account's going to be affected. And so eventually what's going to happen then is this $1,500 right here of supplies debit you're going to subtract that 500, and then in the adjusted trial balance, you're going to put $1,000 right there. That should be the reflect of making your adjustment. And then down here, since you didn't have a supplies expense account set up yet, you added it. Here's your debit. So then in your adjusted trial balance, you would then pull over a $500 debit for that account as well. Another example tells you that you paid, looks like $8,000 for some rent. And this happened, if you look at the dates, because with adjusting entries, notice it's all about the dates. This happened on November 20th. And it looked like you paid all of December's and January's rent. And then it says as of December 31st, 1 month's rent has basically been used up. So the idea would be when you first started off, you probably would have put your cash amount into an account called, probably something called prepaid rent. Okay, and so that $8,000 that is in prepaid rent now needs to be adjusted after 1 month, because it says you basically have used up 1 month. And you know this $8,000 is for 2 months, so we know basically every month's rent is basically $4,000. So basically that is what you have used. So guess what? That's going to be your adjusting entry. Now typically, if you were going to write this in a journal, you would debit rent expense for $4,000, and you would credit prepaid rent for $4,000, and so you again would write that in a journal and post it to a ledger. But in the next slide, we'll show you how it's going to wind up on the worksheet. And once again, notice here's your prepaid rent account right up here at the top. And look how there's a credit there for $4,000, and down here, here's your rent expense. Notice there's your debit for $4,000, and then eventually, again, you're going to adjust these account balances. So this $8,000, when we subtract that $4,000, you're going to end up putting $4,000 right there into your adjusted trial balance. Just like this amount was added, you're going to put, well, that's going to be your actual balance. And then just like this account just got added, so there's going to be another $4,000 there because you're actually now adding that. Okay. Now, another type of adjusting entry you're going to see is something called depreciation. And depreciation is basically the cost allocation. I'm going to write this again. It's a cost allocation of using fixed assets. And when I talk about fixed assets, typically we're talking about buildings or equipment, stuff like that. Stuff that, assets that are typically used for more than one period. And this concept is called depreciation because as you use the equipment, you need to allocate some of that cost of equipment to an expense because you're using that expense, you're using that equipment to make revenue, and the matching says is you need to match revenues and expenses in the time period that they incur. And so we're going to have to do this adjustment called the depreciation adjustment as long as you're using the equipment. Now, predominantly, the method we use is called the straight line method. And as you can see, there's a formula right down there. And that's basically what we're going to do. And so you take the equipment's cost, you subtract out the salvage value, which salvage value, again, is an estimate in terms of what it's worth at the end of its useful life. That'll typically be given in the problem for you. And then you divide by some sort of time period, and we'll use months. Again, that's another estimate. There's a prediction in terms of how many months you're going to actually use the equipment. Once you do this calculation, that's going to be your depreciation adjustment. That's going to be your adjusting entry. So in this example, it looks like the cost is $11,000. The useful life is 5 years or 60 months. And they told you that the salvage value was 0. So if you plug it into the equation, which again is cost minus the salvage value, so 11,000 minus 0 is 11,000, and you divide that by the months, which is 60 months, this is a $183 adjustment. We could basically say every month. If you had to make an adjusting entry every month, that would be basically rounded. That's what the amount would be. And typically, the accounts that we use for this type of adjustment would be, number one, we would debit an account that we're going to call depreciation expense, and then we're going to credit an account called accumulated depreciation. Again, that's going to be $483. Now, this account, which as you read in the book and you go through some examples, that account is referred to as what they call a contra asset. Okay, it's a contra asset, meaning it goes in the balance sheet. It's going to be shown as a reduction to whatever equipment you are depreciating. So if you're depreciating equipment, and in this case equipment was $11,000, on your balance sheet you would have equipment, I'm going to write this right up here, you'd have equipment of $11,000, and then what you'd do is you'd write less accumulated depreciation of $183. Okay, so this accumulated depreciation on the balance sheet is going to be shown as a reduction to get what we typically call your book value. So again, it's in the textbook, read, reference it, but there's a couple things about it. You have to know how to calculate it, and you should also know how it's presented on the balance sheet. So on this slide, they're giving you what the normal balances are. Since accumulated depreciation is a new account, notice the equipment is an asset. Notice that's a debit balance. But because this is a contra asset for the accumulated depreciation, it's going to have a balance on the credit side, which, of course, like I just showed you in the previous slide, that's going to reduce your assets. And notice here on your adjustments how we've got all of our, in this case we had 3 adjusting entries. Notice this, here's your depreciation adjustment that just got entered there. And so now that you've got all your adjustments in, what you then do is you take all these balances from your trial balance and you net these with any adjustments on the adjustment column, and then you're going to update these balances, and then you're going to put those on the adjusted trial balance. And then it's at that point you can now do your financial statements. And just to kind of talk about what I talked about in the previous slides, here is the slide showing you the actual book value, which they're taking the original cost, which doesn't change, and subtracting out the accumulated depreciation to get $10,817. Okay, now the next step is to finish the worksheet, and that's basically to complete the adjusted trial balance and then to do the income statement and the equity statement and balance sheet, which can be prepared from the worksheet. So notice here's your accounting cycle, and we've taken you through all these through each of the first 4 chapters. So now we're at the point in this step 4 where we're actually doing the worksheet and then now getting ready to prepare the financial statements and record the adjusting entries. That's basically what we're doing here in chapter 5. So again, like I said, we're going to take these original amounts and make any adjustments to them, and then these adjustments are going to go in the appropriate adjusted trial balance column, and at that point we can start figuring out what our income and balance sheet amount should be. So notice with cash, you just moved it over, equipment got moved over, and then of course you look at supplies. So you had $1,500 of supplies. Well, if you adjusted it by 500, then of course they didn't do it on this one, but this balance here should be $1,000. Okay, look at the prepaid rent. You were $8,000. Now you adjusted it by $4,000. So you would basically right here, you basically pencil in $4,000. So again, all you're doing is you're updating your trial balance accounts by a debit or a credit, which is for a plus or a minus, and putting those into this adjusted trial balance column. And this slide is showing you how these numbers did get transferred over. Notice there's only 3 accounts that are basically changing in terms of what you originally had. We had 3 adjusting entries. But down here you had to add 3 of them because we didn't previously have the supplies expense or the rent expense or the depreciation expense. But now you do. And so basically this is called, up at the top, it's called your adjusted trial balance. And as you can see, you are balanced once you add the debits and add the credits. So you've got $150,683. So at this point, record your adjusting entries in a journal, but you now know all the information that you can start doing your income statement and your balance sheet as well. So you basically just stop and think what goes on the income statement. So you're going to be basically looking for all your revenues and expenses over here, and you're going to transfer those into the appropriate column on the income statement. And then start to think as well, okay, what goes on the balance sheet? That's going to be all of your assets, your liabilities, and your equity. So you notice you had the fees income here, and then here is all of your expenses. So notice at this point, here's your revenues, here's your expenses, and if you look at the bottom, you have total revenues of $47,000 and total expenses of $13,333. So you could just subtract these. Notice the debits don't equal the credits, but you could subtract these. The difference in this case is going to be a net income. Now, if you look at the other accounts, notice all they did is they just copied them over because those are indeed your balance sheet accounts. You didn't have any adjustments to them, and they've already put those in the appropriate balance sheet column. But also note, if you were to total it, the debits do not equal credits, because obviously you're going to be off by either the net income, and of course net income has to update equity. So we should look at these differences. We should be off by the same amount. So in this case, notice they actually put net income down here at the bottom, and net income is the revenues minus the expenses, which is $33,667. Okay, so there's basically your net income. And then also notice that that's also the same plug amount to get the balance sheet to balance, because remember, net income is essentially going to be transferred into equity eventually, and equity is on the balance sheet. So whatever you're off by here should be the same difference over on the balance sheet. You know, these should always be the same numbers. And that's basically about it. Now, obviously, you do need to put these in a journal format, but we're not doing closing entries until Chapter 6. So we're basically right up to this step 6, where once we've got to the step, we can actually get these recorded in our journal and posted to our ledger. And here's the more formal basic income statement, where you've got your date and you got your revenues, and here of course is all your expenses, and there's your net income. Notice you have an equity statement where you had some beginning capital, add net income, subtract your drawings, and of course you end up with your ending balance. That's the balance that would show up on your balance sheet. And then notice here's your balance sheet, your total asset section, liabilities, and then there's your equity amount, and notice it is balanced. And as you can see, when you're looking at this balance sheet, do you see how they put the equipment here? There's the 11,000. You would subtract out the 183. So here right there, I'm going to circle this. That, guys, is your book value. And so that's always basically your net assets. Remember, the accumulated depreciation, because it's a contra asset and has a credit balance, it always is going to be a reduction on your asset side. And a couple final things. Notice as the worksheet is not a financial statement. It's not part of any accounting record. Notice it's only a tool. So like I said, you know, this book is using a worksheet to give you this visual. It's highly unlikely that you're going to actually do a worksheet in an industry setting, because there's going to be accounting software available that's going to basically do all this stuff for you. But you know, when you're first learning it, worksheets, it's a good way to introduce at least the, you know, at minimum, the topic or the concept of how do you get the adjustments to change the accounts. And on the upcoming slide, we're going to show you basically the actual recording of the adjusting entries in the journal. So notice here's our supplies expense and supplies. Notice debit credit, rent expense, prepaid rent, debit credit, and then here's your depreciation expense, debit credit. And they're trying to show you you've got the dates, you've got post references, you've got page numbers, but just remember, just, you know, to try to keep it simple. You know, this is your journal up here at the top, and then down here there's your ledger. Okay, so in this case this was supplies expense, just trying to show you that the supplies debit is going to get posted down into your ledger. But all these post references, the reason those are set up is for allow for some sort of trace or record to verify the amounts, to verify where the information came from. Typically, this is what the auditors would be looking for. They either call tracing or vouching, where they want to trace from the source to see if they could come up with the same conclusions that your bookkeepers did.